Hey, welcome to the Mortgage Minute for April 16th. Hard to believe we're into spring already, and as always, there's lots going on. You know, I was looking in typical spring headline here. Housing market begins slow bloom. You know, I don't have it handy, but there was another headline that said the housing market is faltering, getting off to a slow start. Yet I talked to realtors in our local market, certainly here in Vancouver, and it's just bursting at the seams. Not surprising. Of course, a couple weeks ago, we had the Bank of Montreal come out and say they're offering 2.99% on 5-year money, and that got everybody rushing in saying, how do I get that 2.99%? What they didn't say is it came with lots of, let's say, strings attached. It wasn't exactly it was a no-frills offer, which meant there was lots of restrictions. And you have to look very carefully at those products because it may end up costing you a lot more money in the long run. Having said that, it was a great way to get people moving in the spring market, and there was almost that get in while you can mentality yet again. So we had a very active beginning to the spring market. And meanwhile, we look at the economy in general. Here's an article yesterday saying that the IMF is suggesting that the economy is bouncing back. Now, this is interesting. Canada's economy will pick up speed in 2014 with stronger growth out of the United States. But the International Monetary Fund cautioned external risks still exist for both countries, being Canada and the U.S., and urged the Bank of Canada in particular to hold off on raising its key interest rates until solid growth takes place. So when are we going to see solid growth? Well, that's anyone's guess. But today we had the Bank of Canada make their announcements, and as many of you may or may not know, the Bank of Canada decided not to raise interest rates and yet again stand pat for, what is it, like 4 years running? But it's interesting to look at the verbiage, as always, when the Bank of Canada makes its rate announcements. Again, some of the notes I took from online here is Bank of Canada kept its neutral stance on future rates intact. The overall message was little changed, though the bank cut its growth forecast. So on one hand, the IMF is suggesting there's going to be economic growth. The Bank of Canada comes out the next day and says, no, we're actually downgrading our economic growth forecast. Found that interesting. Bank of Canada Governor Stephen Poloz, again, did not close the door on possible rate cuts. Not rate increases, but rate cuts. So there's just throwing it out there like a trial balloon. Again, the Bank of Canada trimmed its GDP growth forecast. And one of the things that was interesting to note is they stated the lower Canadian dollar will actually help the economy. This should provide an additional support as rising global demand for Canadian goods and services combined with the assumed higher level of oil prices will stimulate business investment in Canada and shift the economy to a more stable growth track. In other words, read into this, if you're looking to save money by having the Canadian dollar at par next time you go down to the United States, the Bank of Canada doesn't want that. They just basically suggested that. Just another pointed reminder that the Bank of Canada view the weaker currency leads to better growth backdrop. In other words, it's not a bad thing for Canada to have a weaker currency. It helps our economy. And lastly, the Bank of Canada made yet another statement on the fact that recent developments are in line with the bank's expectation of a soft landing in the housing market. And the soft landing in the housing market, although what are they saying? Stabilizing debt-to-income ratios for households. Still, household imbalances remain elevated and would pose significant risk should economic conditions deteriorate. Translation, the Bank of Canada is still concerned that Canadians are taking on too much debt, and I want to put that into context. When they talk about too much debt, they're talking about using household debt to subsidize lifestyle and spend that money on things like cars, boats, trips, and items that don't create wealth. But I would still strongly suggest that Canadians need to start looking at their home equity and utilizing it in a better fashion to increase net worth and subsidize pension plans, etc. But that might be a topic for another day. Ladies and gentlemen, that's the Mortgage Minute today. And as always, if you have any questions, feel free to email us. Send us an email. Go to peterkinch.com. And if you'd like to book a consultation, if your mortgage is coming up for renewal, record low rates still persist. So make sure you're giving us a call and talking about that. Thanks. That's it for today. We'll talk to you soon.